Hi everyone, in this video I've got my next installment of my Q&A with Wall Street series, and this one is going to be with Meta Platforms. And the first question comes from Morgan Stanley analyst Brian Nowak, who's got a two-part question asking about CapEx, return on invested capital, and on engagement. So the CFO of Facebook, David Wayner, responds by saying the aggregate time on Instagram and Facebook both are up year over year in both the US and globally. So that's good news for investors who were worried that time spent on the platform was down because people were spending so much time on TikTok. And then Susan Lee chimes in to answer about the capital investments and saying that we had shared a single AI advancement in scaling our recommendation models had led to a 15% increase in watch time for Facebook Reels, and that gain has continued to grow. So alluding to the fact that this capital investment is already starting to pay off, it's causing engagement to increase. The next question comes from Mark Shmulik and talking about getting back to revenue growth in 2023 and operating expenses in 2023. And the CFO responds saying, we're seeing progress on a number of fronts, but it's going to depend some extent on what the overall macro climate is like. We're not going to be facing significant headwinds next year from the Apple's privacy policy changes that they made to the platform. So in that regard, that's going to be a driver of revenue growth because that's not going to be a comparative disadvantage to have one year's results compared to a previous year's results that did not include the privacy policy changes that makes it harder for meta platforms to sell targeted advertising. Now that in 2023 it's going to be on a like for like basis, and so that's going to cause revenue growth to increase if not accelerate. And then Susan Lee chimes in regarding expense growth that in 2023, 2 billion of the expenses are going to be one-time charges as they, pay to get out of some office leases. Meta Platforms has been allowing some of its workers to do remote working, and that means that it requires less office space, but it had signed long-term leases, and to get out of those leases, it's got to pay a premium, and that's going to be one-time expenses that are going to be paid and then removed from its income statement. So in that regard, while expense might look higher in 2023, longer term expenses might decrease as Meta Platforms pays less money for office space. Moving on, Justin Post from Bank of America asks about the transition into Reels. Remember, Reels is Meta's response to TikTok short form video, and Justin Post wants to know on the progress of that. And David Wayner, CFO, says that it's incremental to time spent, so we're seeing it as a benefit contributing to overall engagement. So in other words, people spending time on Reels are not coming at the expense of spending time on stories or photos and other stuff, right? So that's good news that the Reels engagement is on top of the existing engagement on Facebook, on Instagram. So that's good news to see there. But he also adds that it's going to take time before Reels becomes a tailwind to revenue. It's going to take time for Meta to fully integrate ad revenue into Reels to monetize it at the level it was monetizing stories or the news feed. And Mark Zuckerberg, CEO and founder, chimes in here. For Reels monetization specifically, anytime they've had a new format, like when they added stories or when they went from desktop to mobile, they've been able to figure out and in fact come out better than they were before. So right now, Meta is facing a headwind as people change their consumption from mostly interacting on social media through images. Now people are mostly interacting through short form video. And in the near term, it's a headwind to Meta as this change progresses. But what Mark Zuckerberg is saying, that we've gone through these types of major structural changes before and we came out stronger than we were before. So don't count us out just yet. Look, we've done this before and we've done a good job at it. So why are you not believing that we can do this again? And this next question comes from Doug Anmuth from JP Morgan Chase, asking about the ATT impact diminishing in the third quarter. So ATT is alluding to Apple's privacy policy changes that makes it harder for Meta platforms to track users across different apps. And the CFO responds saying that it was mostly rolled out, like the bulk of the impacts was rolled out in the third quarter of 2021. So now in this year, third quarter 2022, comparing to third quarter 2021, they both included the headwinds from that privacy policy change. So there isn't one year that included it and the other year that did not include it. And in the earlier quarters of Meta Platforms this year, it had that unfavorable comparison where the second quarter of 2022 included the headwinds, but the second quarter of 2021 did not include the headwinds. And so that was forcing revenue to look worse than it actually was. All right, and I will end with this final question from Goldman Sachs analyst Eric Sheridan, asking how much of this investment cycle is informed by your views around future proofing the platform so there are less externalities in the business so you can control your own destiny. So asking Mark Zuckerberg and the management of Meta Platforms, like how much of this importance that you're placing on the metaverse, how much of that is caused by the fact that you're experiencing this lack of control over what Apple's privacy policy changes just did to your business? Are you trying to proof your business for these kinds of changes so that you're not impacted by this in the future? So how much of this investment is due to that fact? And Mark Zuckerberg responds that you see dynamics like what Apple has done with their privacy policy changes and continues to do with some changes are obviously big risks and we see issues. So he acknowledges that this is a big risk for the company, but also says that a lot of this is because you can build new and innovative things when you control more of the stack yourself. In other words, when you control more of the user experience yourself, you can do a lot more innovative and new things because everybody is on your platform, right? Everybody is using your Meta Platforms hardware, your Meta Platforms software, and the whole consumer experience is under your control. So you could do more things, you have more flexibility. And so Mark Zuckerberg is acknowledging that yes, the privacy policy changes are a big risk, but also it will give us more control over the user experience if we are able to have control of a larger part of the user experiences. So I think that enabling more experiences, I think, is the primary driver, and the sort of fortification against these risks from companies like Apple are secondary drivers. All right, so Mark Zuckerberg giving, in my opinion, an answer to the most important question of this Q&A session from Wall Street, because so much of Meta Platforms' stock price decline is due to this shift to the metaverse, these headwinds from Apple's privacy policy changes. So this was a long-term, big picture question that kind of gave investors some insight as to why management is doing this, why Mark Zuckerberg is doing this. Is it just because to protect your business from changes like this from Apple and possibly from Alphabet in the future with Android? Or is this a bigger picture thing? Is there other reasons? And Mark Zuckerberg saying, no, it's not primarily because of Apple or Android. It's primarily because we can enable more experiences if we control more of the user experience. And then secondarily, because yes, it also does decrease our risks. Okay. So that's all I've got for this Q&A with Wall Street session with Meta Platforms stock. If you've gained some value from this video, please go ahead and hit the like and subscribe button. It'll help me make more videos like this one. Thank you for watching, and I'll see you next time. I want to thank the Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for all investors of all skill sets and risk levels. So I'm proud to partner with the Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by more than 3 times. Go to fool.com/parkev to get your 10 stock picks now.